As most of you know, we have done a series on Star Entertainment, chronicling the story of how a combination of malfeasance, grandiose ambition, corporate mismanagement, and outright criminality drove a casino monopoly to the point of insolvency. At the time of recording, Star is losing around $10 million a month, is in hundreds of millions of dollars in debt, has ongoing legal issues and investigations, with a total share market capitalization of just over $300 million, which is down 98% from its height about 7 years ago. The biggest uncertainty has been the future of Star Entertainment's freshly minted Queen's Wharf development complex, which is over $3.6 million invested and rising, currently $1 billion overrun on its initial projections. Back in April, under extreme duress, Star Entertainment accepted a $300 million buyout bid from the American casino giant Bally's. Bally's decision to acquire the floundering Star followed a visit by a delegation to the Queen's Wharf development in February that included Bally's chairman Soo Kim, who expressed confidence in the value of these underlying assets. Well then, is he right? In this video, I offer 5 reasons why Bally's decision to acquire Star Entertainment is a good one, and 5 others why it could be a total disaster. Now, Bally's Corporation is a US-based gaming company headquartered in Rhode Island that has undergone a rapid expansion in recent years since it was acquired by the hedge fund Standard General in 2024. Currently operating 19 casinos across 11 US states and a horse track in Colorado, Bally's also has online gaming licenses in 11 US states and owns 2 other online licenses abroad, Virgin Games and Monopoly Casino, that operates in the UK and Europe. And just recently, Bally's got a total controlling share of Asper's Casino in Newcastle, UK, which is an interesting procurement, and we'll come back to that later. Under the agreement to acquire Star Entertainment, however, Bally's has already paid out $100 million to keep the doors open. That is ahead of any shareholder approval of the underlying takeover. The first tranche will convert to shares, with the remaining $200 million paid out in a second tranche contingent on that approval being given. Now, it's critical to point out that Bally's acquisition of Star doesn't actually include the Queen's Wharf development, as this asset has already been sold to Chow Tai Fook Enterprises. Instead, the takeover arrangement will mean Bally's taking over Star Sydney and Star Gold Coast, while Chow Tai Fook Enterprises continues to own and run Queen's Wharf in Brisbane. So, what are the 5 reasons why Bally's acquisition of Star Sydney and Gold Coast is a good idea? Reason number 1. Bally's is getting 2 massive casino complexes at an incredibly cheap price. To put this in perspective, in 2017, the Star Gold Coast alone underwent a massive development and refurbishment worth around $850 million. A similar renovation expense was incurred at Star Sydney between 2009 and 2012, and while the cost estimates are around the upper end, taken together, this is still over $1 billion worth of asset improvement, which Bally's is picking up in 2025 at less than 1/3 of the price in modern dollars. Reason number 2, the worst of the regulatory risks is probably behind them. Star has already incurred massive fines from both New South Wales and Queensland for its persistent gambling, safety, and money laundering failures. Now, while the fines incurred at Star total at least $200 million with potential AUSTRAC penalties on top of that, some of the legal consequences are actually falling on former directors themselves, with a possibility that there will be a chance to reset relations with the regulator as Bally's comes in and takes over. It's also the case that some of the regulatory measures that have specifically hurt Star, such as the mandatory carded play, will either be repealed or spread to all the pubs and clubs, thereby leveling the competitive playing field when it comes to gaming machines. Reason number 3, the potential upside is incredibly high. Even with all of the problems facing the industry and Star Entertainment in particular, of which there are many, Should Bally's prove successful in weathering this storm, it will be left with a near casino monopoly in one of the most valuable real estate areas in all of planet Earth, Sydney's Darling Harbour, which is a massive tourist spot in the heart of Australia, and a huge complex in the Gold Coast, a massive tourist hotspot. Given that Bally's and Standard General hedge fund backers can presumably keep the doors open for at least the medium term, then even if they end up doubling their initial investment to $600 million before the company reaches solvency, well, if they do make a profit, then the upward investment returns are likely to be massive. Reason number 4. The value of the underlying assets are significant, mitigating the downside risk. Star Entertainment has been in the process of dumping assets at an incalculable rate with pennies on the dollar for what they're worth in a fire sale because the company is in a meltdown. But without this desperation and pressure, the value of these properties are simply huge. For example, while Star Gold Coast is a Crown leasehold, Star Entertainment owns the land on which Star Sydney sits. The land alone in Pyrmont stretches across 30,000 square metres in the heart of Darling Harbour, probably worth around $250 to $300 million on its own, not even counting the casino complex itself. Therefore, provided that Bally's doesn't find itself in distress, it may be able to offload Star's assets to another buyer in a way that substantially mitigates any losses if things don't work out. Reason number 5. Bally's and the chairman Soo Kim have a track record of successfully turning around failing assets. For example, Soo Kim took over Aliante Casino in Las Vegas in 2011 after the previous owner went bankrupt during the global financial crisis. Soo Kim then managed to sell it to Boyd Gaming in 2016 for $380 million US, which was a huge financial return. Likewise, in 2020, Bally's bought what is now Bally's Atlantic City from Caesars in 2020 during the height of the pandemic for a bargain price. They have since invested another $100 million US on top of this and are successfully turning it around. So you might think that with all of these factors, a cheap price, high potential return, deep pockets, and a track record of success, that this must be a slam dunk. Well, not so fast. Yes, there are some reasons to be optimistic, but there are at least an equal number of reasons to believe that this could prove to be the worst financial decision Soo Kim has ever made. So here are 5 reasons why Bally's takeover of Star Gold Coast and Star Sydney might be terrible. Reason number 1, they are losing tons of money. As per Star's earnings report from December 2024, Star Sydney is currently losing $4.1 million per month, and this has reportedly continued into the March 2025 quarter with accelerating losses of 26% year on year. Star Gold Coast is faring better, reporting around a $2.3 million monthly operating profit in September of 2024. However, in March 2025, the revenues have plummeted another 13%, likely pushing the casino into the red as well. Overall, even without the Queen's Wharf complex, the total cash burn at Star Gold Coast and Sydney is around $5 to $10 million per month, which is a significant amount to turn around. And should this continue to deteriorate, Bally's might find it difficult to divest from it because, just like Bally's has found itself, prospective buyers will find their negotiating power increase the longer they delay in making a bid.
No bids for item 751.
$1.
Reason number 2, the circumstances are radically different this time around. While Soo Kim and Bally's have had prior success in turning around distressed casinos, one was during the global financial crisis and the other was during an unprecedented pandemic that shut down global business. What do these two things have in common? They are both acute, unforeseen, and temporary crises that radically impacted short-term trading conditions. In the former, it was due to mass economic pain, and the second was to an actual travel restriction and social distancing. In both of these cases, a person with a level head and deep pockets would be able to weather the storm until trading conditions normalize. And that's the key word here, normalize. Whereas Star's problems run deeper than just some regulator fines and cost overruns at the Queen's Wharf development, severe though those two problems are. There are more fundamental reasons why Star's business conditions are growing less favourable. And because these reasons are structural, it's not clear that just pouring more money in until everything sorts itself out is really going to be the answer. So for example, the lucrative Chinese market has all but dried up as the CCP clamps down on gamblers travelling abroad, while Australia limits junkets at home. Meanwhile, competition is dramatically heating up in the casino market right across the region. In the Philippines, Korea, Malaysia, Singapore, they're all building new casinos. On top of that, Japan and Thailand are opening their first casinos ever. Not only do these massive new offerings soak up the local Asian market, they also drag Australian customers abroad with all the cheap, frequent flights and amazing affordable accommodation and gaming options. And so with all these other better gaming experiences being on offer, even if all the domestic problems in Australia were solved overnight, so the housing affordability and cost of living crisis normalised, there's no guarantee that the high-flying locals are going to want to spend their money at Star, Sydney and Gold Coast when they could travel a few hours on a flight to a newly minted Thai resort. Reason number 3. Bally's may not understand Australia. Right now, the United States is experiencing a new gambling boom nationwide ever since the Supreme Court cut down the federal ban on online gambling in 2018. For American companies, it's a new Wild West, and despite recent stock market volatility, there's plenty of opportunity to profit from US consumers. However, the situation is very different in Australia. Australians have long been the biggest gamblers on earth, and many of the businesses that are novel in the US are mature and saturated in Australia. Community attitudes towards gambling generally have been souring, and political pressure to do more to curb gambling spend is consistently rising. This is what is driving measures like the mandatory card of play to begin with, and it's important for Bally's to understand the voices who are anti-gambling are getting louder and stronger. And more importantly, business conditions and culture in Australia is radically different to the US. For example, the average salary of a casino dealer at Star is over $60,000 a year, while that of a Bally's dealer is roughly half that, even accounting for exchange rates. Ergo, the most attractive area for cost cutting at Bally's will be in labour costs, cutting down staff numbers and outsourcing work remotely. However, the antipathy that this would generate among Australians, unions and politicians would result in an almighty backlash, as locals become resentful that Australians get all of the gambling problems, debts and family breakdown, while the jobs and opportunities and profit flow inexorably abroad. It's not clear to me that Sue Kim and Bally's fully appreciates the political and social dynamic at play. Reason number 4, the market just isn't big enough. The way this deal is structured means that the massive multi-billion-dollar Queen's Wharf development complex known as Star Brisbane is going to be in direct competition with Star Gold Coast and around 90 minutes away on the train. And having recently toured the facilities myself, noting that there are a lot of problems, retailers are absent, office fit-outs are not completed, and the massive casino floor space is chronically underutilized, it is still an extraordinary structure in the heart of Brisbane CBD with a potential chokehold on the Queensland capital gambling market. Check out our new poker room review of the Star Brisbane for a lot more information on that. Now, Bally's is going to have to try hard to compete with this behemoth, dependent entirely on Gold Coast tourist market. This is a radically different scenario than when the assets were all under a single owner and the two venues could share resources and suppliers and create synergies in rewards and incentive schemes between the two sites. Now, it may be that Bally's will go to Chow Tai Fook Enterprises and try and buy them out and work out a deal separately, but there's no guarantee of this, or if they do, that it'll be successful. If it isn't, then Star Gold Coast is likely to be the one that gets strangled in this arrangement. And reason number 5, Bally's may not have enough capital to make this work. Now, it might seem strange to say that about a major casino giant backed by a decent hedge fund. However, Standard General Hedge Fund is estimated to have around $710 million in discretionary assets under management and around $200 million in managed securities, which, while more than you or I have in our accounts, isn't actually a gorilla when it comes to hedge fund standards. And if it turns out that Star Sydney and Star Gold Coast end up needing hundreds of millions of dollars more to turn around than was initially anticipated, things can get rough pretty fast for Bally's, just as it has for Star itself. And like I said before with Australia, Bally's doesn't have much experience in overseas markets, having acquired its dominant position in Newcastle just this year. Now, I have actually scouted out Newcastle myself and reviewed the Grosvenor there. Newcastle is an absolutely gorgeous city in the far north of England, which has a lot of potential. So perhaps Sue Kim's instincts are strong, but even here there are some significant downside commercial risks that may be underestimated. The point is that Bally's may fall to a sunken cost fallacy, much like the Star executives did before them. After investing hundreds of millions of dollars to acquire Star Sydney and the Gold Coast, and hundreds more to keep it afloat before turning it around, well, it might end up becoming a permanent ulcer on Bally's bottom line, not wanting to cut their losses given the asset's underlying value and how much they've spent trying to make it profitable. So, am I predicting that Bally's is going to fail? Well, no, it remains the case that no matter what, Bally's is getting a bargain here. However, the risks are way, way bigger than most people think, and there's nothing that Bally's Corporation has said or Sue Kim has expressed, other than perhaps braggadocious confidence and a history of success, that makes one think they understand the underlying issues here and are well positioned with a credible plan to take this forward. So do I think that there is a way of making Star Entertainment successful and profitable in the long term? Yes, I absolutely do. But it's easy for me to say that here when it's not my risk or reward to implement. So I guess we'll just see how Sue Kim and Bally's performs. Anyway, that's the latest on this. A reminder again that you should check out our tour of the Queen's Wharf Development Complex over at our Poker Room review. Otherwise, thank you for watching and we will see you next time. Goodbye.